Michael, welcome to Face. It's hadn't talked to you for a few years, and now within 2 days we've had a chance to talk to each other. Welcome. Any initial reaction to what we have happening here on the NFP?
Well, first of all, I appreciate the invite, and I will say that for those that missed the interview I did with Dale yesterday through X/Twitter Spaces, was really phenomenal. I forgot, I hate to say it this way, but I forgot how good Dale is at not only communicating his thoughts, but also having original ones. So I kind of stepped in a little bit last minute. I just came back from the gym. I did not have this on my calendar, but I'm a man of my word. So when Dale reminded me that I said to come on, I figured I better show up. So
I blackmailed you.
No, yeah.
Anyway.
So let's get into it. Yeah, it's so initial. First of all, as we know, usually the initial reaction with this stuff is probably the wrong initial reaction, right? It's not. You have to see how this plays out. I don't know if any of this is ultimately going to matter too much, and I say that because we are in this situation now where if Treasuries don't start to stabilize, there could be some really nasty after effects on all risk assets, no matter how good economic data looks. Right. I mean, if you look at very simplistic, if you look at a chart on TLT, I mean, this week it looks like a crash. It looks like we've basically had another crash.
There's your weekly candle.
Right. So now some people just look at this and say it's a chart. It's like any other chart. It's not. Treasuries are the core to everything. Now, back in October, I was making the argument that I said the end of the world is the bull case, and I said that because the speed with which TLT was falling, yields were rising back then, would have suggested that mortgage rates would have been like 20% in November. Had the yield rise in early October continued at that pace, it would have been catastrophic. And my argument back then was you can't bet on that, and then that's what starts to melt up in equities. The problem is you're now back at that point, and equities have nowhere near priced in the possibility of this yield shock that we may now be in when it comes to long duration Treasury. So I say all that to say that I think that if you're going to do anything from a trading perspective, you have to watch Treasuries in particular, because if they don't start to stabilize, I think it's a very, very nasty setup.
Yeah, look at those gaps, Michael. So you rarely see a market gap down like this. So this is classic definition of trying to catch a falling knife. So they're called, about steady on this. 10 years up a couple bips. So 10 years making new highs for the move right here.
Right. The SP now is flat or is negative, right? Undid the gain. So that's what I'm saying.
Yeah.
So this will be interesting because if let's say the knife stops falling, okay, if it stops falling as a new knife starts falling, which is the S&P, which is what I've been on the watch for. I keep referencing this point of, I call it the flippening. Right. I always try to find terminology. The flippening meaning, where you see intraday a big decline in stocks and Treasuries rally. Right. So this goes back to kind of my world from a risk on, risk off perspective, which has really been challenged the last year and a half. But, Treasuries in high volatility sequences act like a short on equities without the risks of shorting. Right. Meaning you can see that you look historically at major declines, you'll end up seeing, periods where the SP is down 2% and TLT is up 2%. Right, because it's just that flight to safety dynamic. So that sequence, that flight to safety, that Phoenix rising, that flippening, all these different analogies I use, that I think is the thing to watch out for, because as I keep referencing, the conditions favor a tail event here from all the intermarket work that I do. I laid it out on my pinned tweet. I don't think anybody is anywhere prepared for what could be a credit event. And by the way, the Treasury markets may be starting to tell you that something's happening on the bond side. And it's happening. All this, by the way, is happening with everybody on vacation, which is often the way this stuff happens.
Right. Well, Michael, I look at what happened in 2022, and it was a decline in the stock market. We had 30% sell off, and during that we had very little flight to quality. In fact, the bonds led the decline in the stock market. So, even I think that there could be a flight to quality rally in bonds, but, that would mean a reversion to the way things used to be. And maybe they're both bad together and both good together, because people were not protected in 2022 by having, 30% in bonds. It turned out to be a bigger loss than their stock portfolio. So
right. And
so,
I will say,
why is it going to change?
Yeah, because yields are higher for one, right? And I think I'd argue that last year was an anomaly, not just in terms of stocks and bonds losing money, but rather in terms of the way in which it played out. Last year was like a controlled implosion in two asset classes that tend to act counter to each other when there's an implosion. Right. So that whole sequence, I'd argue, is what was the anomaly. But your point about kind of going back to the way that it was, by the way, that argument of the way that it was goes back to even prior to the bond bull market of the early 80s. I always go back to on the point you just referenced around treasuries losing more money than equities. In 1968 to 1970, you had a major drawdown for stocks. Treasuries, if TLT were around back then, it would have been down around 14, right? If it would have been down around 14% in the midst of a 32% drawdown for the S&P. Both asset classes were terrible in the context of that equity drawdown, but Treasury still looked like the better place to be on a relative basis. So you don't have to necessarily go back to the perfect, kind of flight to safety dynamic that we saw post Volcker, but you can certainly go back to a period where treasuries on a relative basis meaningfully outperform equities. Now, how would that happen? Because yields are not going to really collapse in a massive way. It would happen with stocks doing the heavy lifting on the downside.
Okay, and we talked about this briefly yesterday, but what's been happening in corporate and junk actually having not a bad looking structure. So can you explain why money flow prefers junk to sovereigns? Can anyone explain that to me?
It's hard to explain. First of all, you can always explain anything with any kind of narrative, right? That's always what is kind of the joke about this industry. But you're hitting on something which is why there has to be a great readjustment, because it doesn't make sense. Like the argument that, for example, somebody sent me a tweet, he then deleted it yesterday, saying Apple is safer than U.S. government debt, and I said this is complete insanity. Okay, Apple does not have a military. Okay, Apple does not tax. Okay. And it's like
they have one in the metaverse. If you put the goggles on, you can imagine.
Exactly. But that's my point. It's like you're telling me that if the U.S. government, if its debt rating keeps getting downgraded, you're telling me they're not going to tax the ever living hell out of Apple and every other company to try to counter that, right? I mean, it's a silly concept. So, but that's the narrative of the moment. That's what justifies. I'm using that as an analogy to justify the junk debt.
Well, you know what I tweeted on that subject? That the people think Apple's a bond, Michael. I said, well, they could end up being correct if Apple crashes like the bonds did.
Right.
Then they're right. It was a bond.
Right. Exactly.
But money, and we're going to gap lower in Apple today. So I'm just wondering why money managers are going to junk over sovereign. They have more confidence that junk is going to pay off more than the U.S. government when we have the printing press. I'm just trying to get my head around it. I've been watching.
It's mind-numbing. It's mind-numbing. I said this last year. Obviously, I was very early, but I do maintain this idea that it's only a matter of time until a duration crisis becomes a credit crisis, right? So you haven't had the credit crisis right yet because spreads are still very tight, and you haven't had that VIX spike that typically is the marker of the end of a bear market, right? The capitulation. You didn't have that in equities, right? So, which is why I keep going back to I still think we're in a bear market, right? I could be wrong, right? I know it sounds crazy, but...
Yeah, we never had the capitulation. We need like a 40-50 in the VIX.
Yeah, and that tends to mark the end of it.
To happen.
Right.
So, maybe we're starting it this week. You have a little reversal week this week and pretty good action. If we hold above all the averages here, but I can make a case for 48 if I get what I think is going to happen in the market. We never had the capitulation in 22, and now I think that the market is long enough for that to happen.
Yes, correct. That's correct. Which is why I keep saying no one is prepared. That's why I keep saying it has to. Not only does it have to, I'd argue, come from left field. Right, because I keep going back to the the way that last year played out really, I think, messed with people's perceptions of how markets decline, because it was very controlled. It was very gradual. It was not an elevator down, it was a staircase down last year, right? So in order for the market to shock, the public back into the way markets tend to work when there's left tail risk, it has to be very sharp. It has to be very sudden. It has to be something that you can't necessarily position for based on some, trend line. Right. So that's why I keep saying it's a credit event. Event implies something that it happens in a compressed period.
Okay. So you think part of that is going to be what happens in US dollar yen. Can you explain? Now, this is a number I was talking about, the 42 number yesterday, Michael. And I also said that there'd be a relief in the dollar. I thought the dollar was oversold and we'd have a little pullback. So that's adding a little, support to the stock market short term. Nothing major. S&P's up 7, Nasdaq up 28. But the yen, I wanted to give you the macro look. First of all, back under 42 is not going to be good. Right. But under 138, it sets up this kind of move. And tell me what this would do to the stock market. So here was the high last fall. BOJ was intervening. Fed was jawboning to help the deal out. Had the big break, putting in a lower high here, came off, putting in another lower high. So if you just have equality here, from here, it takes you down to 120. What's going to happen to risk in a situation like that? Well, and why would that happen?
First of all, I would argue that as that's happening, cannabis sales are going to skyrocket. Because everyone is going to want to get high to escape the stress of a declining market and high volatility period.
I don't need that. I don't need that excuse.
No. Of course I'm kidding. But the point is that no, I mean, it goes back to the carry trade dynamic, right? So if you end up having the yen rising, which is consistent with, which would be the dollar yen falling, obviously, that ends up happening against the leveraged positioning from a carry trade perspective, that unwinds and causes a forced global margin call, which we've seen historically. So, people forget the yen, is also a risk off play.
Yeah.
Right. I mean, there was a period there with Abenomics where that broke, but prior to Abenomics, that was the case. When you have high volatility, the yen would rally. You'd have repatriation from investors back to Japan and selling off of other assets, which includes U.S. equities, in particular tech. So all that is still consistent to me with, the broader risk off period. Dollar euro, right, would rally. Dollar yen would not.
Okay. So we're getting a little bounce in the euro. I'm still constructive on the dollar. Any other topic that's top of mind? I know you want to get ready for the opening. Did you want to talk about Bitcoin? You asked me about Bitcoin. I was surprised you did. So I'm curious what your view is on that asset class.
Yeah, I mean, look, I tend to be a natural contrarian, which, by the way, has nothing to do with my funds, because, again, the rules based. I have to keep on emphasizing that for those that can't differentiate between me as a fund manager and me as a thought leader. But the thing everyone assumes is that Bitcoin keeps being correlated to the Nasdaq. Now, if you have a sovereign debt crisis, I'm pretty sure Bitcoin was built for a sovereign debt crisis. So it kind of makes sense that if you're going to have a credit event, and if you have a reversal of a carry trade, and you have further downgrades of government debt, like we saw with Fitch, right? Yeah, that seems to be like the exact kind of perfect storm for Bitcoin to diverge, right, from other risk on assets. So we'll see. It's like, you always have to think in terms of, I think you always have to think in terms of what is the narrative that people will be will strongly argue for after the fact. Well, like, you have to kind of imagine what's the chapter that will be written. And the chapter will be written if you have a sovereign crisis, then yeah, Bitcoin diverges. But nobody sees it yet because it's not in the historical correlation.
Well, how about the duration risks being exacerbated with what's happening with treasuries and all the banks that still have duration risk on the books? I talked about yesterday, Pac West Bank going under. They didn't even write about it. Some bank just took it over. Heartland Bank. I would think after the move in yields in the last week and a half that these banks are even under more pressure.
Oh, there's no doubt. There's no doubt. And this is why it's like, how do you not have a credit event then? So, suddenly now that implies what? The yield curve probably gets even more inverted. Okay. And, the lending gets even more constrained. So I keep using that line, slowly, then all of a sudden, slowly the credit side keeps on, not being as aggressive in terms of how much is out in the economy. And then suddenly it looks like it's almost completely stopped and turned off. And then it's like, all right, well, suddenly you have a tail event. So look, I'm not trying to be a perma bear by any means, right? I mean, it was very aggressive saying melt up, and I've been at this game for well over a decade on the content generation side, analyzing markets. When I see so many people assuming that we're in a new bull market when they seemingly forgot we went through the fastest rate hike cycle in history, which from a lags perspective starts to hit now. That's when everyone should start to get really nervous about the assumption that the future looks like the past.
And recall when Paul started on the tightening regime, everyone said that, he was going to tighten until things broke.
Yeah.
Well, SVB was the system breaking, something breaking. Okay. Even though they patched it. And yet he continued to tighten after that. So I guess that's no longer a, red line. That it's okay if things break. That he's going to continue.
You make a good point, right? Because it's like you can argue things have been breaking just from bankruptcy filings that are picking up, right? The thing that has not broken is junk debt, is this, which goes back to credit spreads. That's coming.
What would it take?
It's a good question. I mean, the catalyst is only known with hindsight, and I think it's the carry trade that just kind of unwinds the leverage. But that's the thing. Maybe it still is going to be a delayed effect from Fitch. Maybe there's something else that happens, right? But when the tinder is dry, it doesn't matter what lights the fire, right? All you know is that the risk is there to get burned, right? So that's why I would say it's more about conditions rather than it's this or that. I happen to think it's going to be the carry trade unwind. It seems almost too perfect because it has to be something that it's almost a little bit hard for people to understand. It's not intuitive to think about how Japan is a big, not a butterfly, but it's a Mothra when it comes to global markets.
Okay. Jane, you have a question? I wanted to show where people could get Michael's work, lead lag report. That's also his Twitter handle. Has a lot of subscribers. You can, check it out for free and then upgrade. So all you have to do is this, and you'll get it. So check out Michael's research. He's one of the greater thinkers in the markets. No one's perfect, but I consider what Michael is looking at in the market to pay attention to and include it in my intelligence gathering. So Michael, last thoughts going into this August season where bear raids are, if they're going to do it, what great conditions with everyone in the Hamptons.
Yeah, right. Exactly. It's true. Is if not now, when?
Yeah, because they'll come back after Labor Day. Maybe they come back to a different looking board.
Yeah, I mean they'll still be rich. I mean, that's the frustrating thing. Right.
Yeah, well, they will still be rich, but maybe their stock portfolio might take a little ding here. Right. Anything you're worried about overseas, geo-wise? Does that factor into what you think with what's happening in Ukraine or what's happening with China? They're launching a new currency. I hope that's all they launch at the end of this month. And anything that you kind of keeping an eye on that keeps you up at night?
Well, I wouldn't say it keeps me up at night, but I put a tweet out saying plot twist Brazil. Right. Okay. And that was yesterday. And, Brazil was the pretty much the earliest central bank to raise rates way before the Fed. Now they're starting a cut cycle. So if Brazil is maybe with the Selic a bit of a leader, oddly enough, in terms of reacting to inflation, disinflationary pressure, their pivot might be first. The Fed's pivot might be, obviously with the delay. And I keep going back to that point that Fed pivots are usually not good. That's often when the drawdowns, start to occur because it means the Fed already over tightened. So we'll see. Okay. There's it's an interconnected world, and nothing is that simple.
And also, Michael, a lot of people were moving away from the US, looking for outperformance in Europe and emerging markets. And you look at the DAX and the Nikkei, the DAX is already, looks to me like it's broken down, and the Nikkei is right on important support. And I'm thinking if the yen does take out 142, Nikkei will break down too. So, you know, could that be a trigger? Something from overseas? They led on the way up. Maybe they lead on the way down here.
Yeah, it could be. And I'll tell you, the emerging market side is always a sore point for me because, you know, my mutual fund ATACX tries to play risk on with emerging markets from a rules-based perspective. And it's like death by 1,000 cuts. Every time it looks like EM wants to run for the last decade, you get a momentum signal, it just doesn't want to stick. Right. So I think that has all kinds of other implications also, you know, permeating to Europe. I think the Eurozone is far more of a problem for the world than anything else very long term. But the leverage is not anywhere near as high as what's being created by Japan. But yeah, I'm with you. I think I think the point on this whole discussion is you have to go beyond the home bias and in thinking that it's only about earnings and thinking it's only about the U.S. market.
Yeah, there's a global thing happening here.
Yep.
Okay. Well, I'm glad you're on the planet, Michael, and I have a chance to talk to you. I really appreciate you dropping in on a busy day. I encourage people to go to your Substack and sign up for the Lead Lag Report, and at the minimum, follow Michael at Lead Lag Report on Twitter. So thank you, Michael, my trading warrior brother. It's great hanging out with you this week.
I appreciate it, Dale. All right, we'll be in touch.
All right. So that's a wrap, everyone. Could join the team in 20 minutes on the Morning Edge. I hope you enjoyed Michael. I know that I love talking to the guy. I could ask him anything. So have a great weekend, everybody. Don't just count your pips, count your blessings. See everyone Monday. Thank you, team, for laying it all out on the court and doing your best to keep people on the right side of things. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.